This is Scott Becker with the Becker Private Equity Podcast. Thrilled today to be joined by brilliant leader Matt Wolf at RSM. One of the things that's been fascinating over the last year or two is as interest rates have gone up, the private equity deal environment has softened some. Decent by historical numbers, but by at least compared to pre-COVID numbers, but softer than sort of the numbers that blew up in the middle of interest rates being really low and potential tax changes when things were on fire in the deal environment. Now we're seeing, again, a return to some investment banking layoffs, just as we're starting to see the deal environment start to pop back up a little bit. Matt, can you help us understand what's going on out there? Can you give us a sense of what you're seeing?
Yeah, happy to, Scott. I think, obviously there's probably specific reasons in some companies, right? I can't speak to any specific company strategy. I just don't know anything more than mostly more than what they publish. But I think at a broad sort of level, what I understand from a lot of these investment banking shops and houses is that they are doing this to prepare for the coming deal environment, right? They're trying to align their banking organizations, their structures, their bankers to where they think deal volume is going to be. And they're also, really hesitant about kind of overbuying, right? Of hiring too long for this next cycle. So, it's been something that's been on a lot of the headlines across, Bloomberg Terminal, other financial news sources, of course, over the last few days or few weeks even. I think a lot of it is restructuring. And I think a lot of these banking houses, they're just trying to get themselves in order, get ready for the coming deal environment, right? All signs are pointing to global central banks cutting rates, starting, well, Swiss Bank already did, right? We're going to get more, probably Bank of England, Fed in June, throughout the rest of the year. Like the rates are coming down, deal flow will return, and these players are getting their houses in order, so to speak, to prepare for that. And they're concerned, I think, and what I understand, what I've heard about hiring too long, hiring in the wrong sectors for these bankers.
And talk about that, because it seems so strange that we're starting to see the deal environment creep back up, and we're starting to see signs at every place. I'm seeing more deals come across our desk, more investment opportunities, more different types of things. And at the same time, you've got this situation where some of those banks seem to finally be catching up to the fact that it slowed down the last year or two. But it seems like a timing when we're about to see deals come, or is it just a chance for them to sort of get rid of some people, bring on some new people? Is it more just restructuring and an excuse to change out people, or is it really trying to get a little bit leaner when things look like they're going to start turning up?
Yeah, so there's definitely, from the conversations I've had and what I understand, is that there's been, some of it is true restructuring, of course, that just kind of happens all the time, right? Banks are always looking at their investment banking headcount. Like, that's not new. But there's also, at least from some of the kind of what I might consider, leading in at least certain sector investment banks, is, they're recognizing that deals going forward are going to be more complex, right? And, obviously banker brings relationship network and things like that to the table. Especially more experienced ones, but they are also looking and saying, we're going to be spending a lot more time per deal to get these things done. Yes, rates are going down, but they're not going to go back to where they were pre-COVID. So even as the deal flow returns, the time to execute these deals, the amount of hours it's going to take our teams to get through these deals that are going to have more complicated structures, the financing is going to be more difficult. Like, we need to be very specific about the industries and the subsectors and the niches that we play in, because we want to make sure we can win, because the sort of cost per transaction is going to go up from a banking perspective. So they got to. I think that's really the view for a lot of these banks and moves based on what conversations I've had.
Thank you. And when you look at the deal environment there at RSM, Is there a palpable sense of excitement as it starts to? I mean, you guys did an incredible job during a time that wasn't that busy for many places, staying quite healthy and quite busy. Is there a palpable sense of excitement there, or can you talk about that, or is that too sensitive to talk about sort of the emerging deal environment that seems to be coming forward?
Oh yeah, definitely. I'd say maybe reserved excitement, right? We're excited we're seeing more deal flow. We're seeing, just like you, right? More deals, more opportunities come across our collective desks as well. Um, I think just like a lot of market participants out there in the deal flow environment, we're not quite sure we're ready to be heard again, right? We want to make sure that it's sustainable, and we want to make sure that the volume really is there before we ramp up too much. But it is coming back. But like you and I have been discussing for a year or more, as this deal flow comes back, it's just going to look different, right? There's different elements that are getting scrutinized in diligence. There are different elements of purchase considerations that are being structured and things to consider, and sellers have new viewpoints. So the deal flow is coming back, and it looks pretty different in most cases than what we saw before.
Fascinating. And do you expect, or is there a discussion about interest rates coming down and that helping multiples again? Because what I'm seeing in the world that I live in is multiples are down a little bit from a couple of years ago. That doesn't mean on every kind of deal, but in general, I would say that the multiples are a little bit, they're certainly far better than they were a decade ago, but they're not the 16s that we were seeing a couple of years ago. More things 8 to 12, et cetera, depending on size of deal and all kinds of different factors. But is there a sense that multiples will creep back up, or is it going to take interest rates really going down to push that?
Yeah, there's definitely going to be a lag. So we have to contextualize for the audience, right? That are just remember that this interest rate hike campaign that has basically concluded, right, by all measures concluded, was historic, right? It was the most aggressive number of rate hikes in the shortest amount of time in the last 40 years. So multiples reacted to that pretty quickly. They generally don't. And I expect that as interest rates come down, it's going to be a while before, in general, again, before multiples recover, particularly in areas that have been most affected by the multiple reduction, like tech. That's broadly speaking, right? Different companies or different niches are going to have different experiences, but the other thing that's changed more so than just the prime rate is investors, sponsors, management teams have really fundamentally shifted from sort of growth back to value. And until companies can prove out outsized cash flows, sustainable growth, those sorts of fundamental financial and operational performances, the multiples aren't going to recover almost regardless of 50 basis points here or there on the interest rate environment. My opinion.
No, I think that's exactly right. And so there's a real shift in things, sort of money because it's cheap again. Right now, it's still very challenging, and the debt finance is expensive and challenging. Matt, as always, I want to thank you for joining us and sharing your wisdom with us on the Becker Private Equity Podcast. Again, Matt Wolf of RSM, one of our top listened to guests, regular guests on the Becker Private Equity Podcast. Matt, thank you very, very much.
Thank you, Scott.